One widow making $80,000 a year paid $9,908 in federal income tax. Her neighbor, also making $80,000 a year, paid zero. How? Why? How can that be? The one lady paid $10,000 more in tax on the federal level than the other lady with the same amount of gross income. We're going to dive into that today when we look at chapter 4 of my book, The Tax Bomb in Your Retirement Accounts, which you can get for free on the PDF version. If you just go to heritagewealthplanning.com, you'll see the pop-up. You just hit your name, your email, and it's just your first name, your email, and your state, and you can get the PDF for free. Now, if you come over here to Amazon.com, you type in Josh Scanlon. Let me minimize myself here. You can get the Kindle Unlimited version. It's also for free, and you can get the Kindle version for $4.49. Here's my other book, Strategic Money Planning. Both are free for Kindle Unlimited. Both are $4.49 for Kindle, and then the hard copy in this was the soft cover. This right here is $5.99 because it's black and white. This one we did in color, and in hindsight, I wish I would not have because it made it a lot more expensive. It was $18.99. So again, you get it free on Kindle Unlimited, $4.49 for regular Kindle for both these guys. Or if you just want, go to heritagewealthplanning.com, and the pop-up, and you can get the PDF for free. So we're going to talk about the 4th chapter of this book. And when you go to heritagewealthplanning.com, this is the exact version you're going to get is this PDF right here. But I can't show you that and my mug. And so I'm going to go to the Google Docs version here. And I think I can show you myself when I got you. Yeah, there we go. Sweet. All right, so let's go right into this. I'm going to show you the Google Docs version of this so I can keep my face on there. Just bear with me just a second. So what's going on here is we got, and this is, again, the 4th chapter. I don't know if I can click on it. No, I can't do it here. Okay, so the PDF, you just click on that. It'll take you right there. So we're going to chapter page 23. Let me just pause it real quick. I'll get there. All right, so in the previous chapters, we talked about how Social Security benefits are taxed, and we use a term called provisional income, and that's going to play more of a role here as we go forward in the book. Also, we talked about the widow's tax trap, and that's part of chapter 2, the widow's tax trap, which is when you're married filing jointly, you get 2 standard deductions, and you get a higher income threshold before you pay higher taxes. And when you're a widow or a widower, you only have 1 standard deduction. You have a lower income threshold before you pay more tax. And then when you throw Social Security in there, it gets even worse. And we did not do that in the widow's tax trap because we're going to start you here where I show you how bad it can be. So as we discussed in the previous chapter, if a married couple's provisional income is $32,000 or less, they pay no tax on the Social Security benefits. However, for a single taxpayer, if provisional income is greater than $34,000, they pay up to 85% of their Social Security benefits is subject to taxation. Again, another widow's tax trap. Married filing jointly, $32,000 Social Security, not subject to income tax. Single taxpayer, $32,000 to $34,000, 85% of the benefit could be subject to income tax. That's not good. All right, so let's say you have a single taxpayer, and we'll just use she, and she has $30,000 distribution from an IRA and then $30,000 of Social Security benefit. What is her provisional income? All right, so remember, provisional income, how do we figure it out? Well, right here from Kiplinger's. Provisional income is half your Social Security benefit plus any other income that you have except for Roth IRA distributions. All right, so that could be tax-exempt interest, that could be IRA distributions, it could be capital gains, it could be earned income, you name it, it could be anything to include tax-exempt interest. I just got to throw that out there. So in this case, she has $30,000 of any other income plus $30,000 Social Security, so we take half of her Social Security, $15,000 added to $30,000 of her income. Her provisional income in this case is $45,000. So what we want to do here to show you how that is going to be subject to taxation, we go up here to our trustee. This is the chapter previous right here. All right, so if she's single, which she is, less than $25,000 is not subject to taxation, but anything above 25 to 34 is 50%. So what we do is we say she had $45,000 of provisional income. So we subtract $25,000, which means $20,000 of her benefit is what we're going to use. Now, of that $20,000, 9,000 is going to sit in this threshold here. So that's going to be 50% of 9,000 is 4,500. All right. Now 11,000 will be sitting in this threshold right here. And you times that by 0.85 equals that 9350 plus the 4,500. And so her taxable Social Security benefit will be 13,850. Now, it's going to be tough to figure this out just by me yapping, but you just got to understand, you take your total provisional income, 45,000 in this case. The first 25,000 is not subject to taxation, so we can wipe that off the mat. Now we still have 25,000 less. So you take 20,000, subtract from the 9,000 because 25 to 34,000 is 9. And that means that 9,000, 50% of that 9,000 is subject to taxation, which would be 4,500. Now we take anything above that 9,000, which in this case is 11,000, and we times that by 85%, and we add those two numbers, and that's how we get the 13,850 of her Social Security benefits is taxed. I hope that makes sense. As you go through the book, I think I have 30 tables that will kind of show you how this works. So keep tracking because it's important for you to know how that works. All right, so that's provisional income. All right, so let's look at the chart below. Let me see if I can make this bigger. Let's see if I can make this a little bit bigger. There we go. Hope it's not too big. There, sweet. All right, so income, Judy and Jane. So they both have 30,000 Social Security. They both have IRA distributions, but Jane's is from a Roth and Judy's is from a traditional IRA. They both have $60,000 of gross income, of total income. Gross income, not spending money. No, that's not spending money. That'd be gross income before taxes. Now, let's see what their taxes look like, though. Whoa, wait a second. IRA distributions, $30,000 for Judy. We've already talked about her Social Security, the taxable Social Security. So we add these two amounts, and her taxable gross income, adjusted gross income, is $43,850. Subtract her standard deduction. Her taxable income is a big fat $30,550, which means she owes $3,500 in taxes, roughly $3,476 to be precise. Jane, on the other hand, because she has no taxable IRA distributions and her Social Security is not subject to income tax. Why is her Social Security not subject to income tax? Because her provisional income is just half of her Social Security benefit. It's only $15,000. And if you remember, anything less than $25,000 for a single taxpayer is not taxable Social Security. So she has no taxable Social Security, no taxable IRA distributions, no adjusted gross income. She has a standard deduction of $13,300, but she doesn't have a taxable income to deduct it from or gross income to deduct it from. So she has nothing in taxes. Pretty good. So when you think about that, so in this case, Judy's going to have to pay $3,400 more each year. Essentially, it's going to get worse too as her IRA distributions increase because of required minimum distributions. But either here nor there, she has to pay $3,400 more a year in taxes than Jane does. And over the course of 10 years, we're talking nearly $35,000, my friends. $35,000. We're not even talking about state income taxes either. All right, and this is what I say. Just think what you could do with that extra $3,500 a year: long-term care, auto payment, Medicare premiums. Medicare premiums, when you factor in your Part B plus your Medigap, your supplements, or your Medicare Advantage, and then Part D's as well, it's going to cost about $3,500 a year. That is real money. If you could save it from tax, it'll go into your pocket. Unfortunately, it doesn't stop there. Ever since John died, Judy has wanted to take her daughter on that month-long cruise. No time like the present, she says. So she takes an IRA distribution this year of $50,000 to pay for the cruise. Thankfully, they had a lot of fun, but watch what happens when she calls her tax guy. Now she owes almost $10,000 in federal taxation, nearly $7,000 more than the year before, even though her income only increased by $20,000. So if you take your trusty calculator, she took $20,000 out, but she owes $7,000 more. That is over a 30% increase in taxes. So her income went up by 33% because before it's $60,000, now it's $80,000. But her taxes went up by 250%, because she paid $34 before, $340, $3,476 before. Now she pays nearly $10,000, a nearly 2.5 times. 250% increase in taxes with only 33% increase in the actual amount of money she has to spend. Even worse, though, she's still only she has 7,000 taxes on 20,000 income. That means that taxes puts her in the 35% tax income range, but she's not in the 35% tax bracket. She's only in the 22% tax bracket. Interesting, huh? She pays $7,000 of taxes on $20,000 of income. That simply means that is a 35% tax bracket she's in, even though she's only in the 22% tax bracket. How does this happen? Well, let's break it down. This is where the double taxation on Social Security benefits ticks me off. All right, so we're going to go through income sources. We have Social Security and IRA distributions. That's it. Her total income is $80,000. Let's keep it going down. All right, so far so good. Her provisional income, half her Social Security benefit plus all other income, her provisional income is $65,000. Now we determine her taxable Social Security. So her Social Security is $30,000. How much of that is going to be subject to tax is based on provisional income, and it's based on this number right here. The first $25,000 we throw out. The next $9,000 we put times it by 1/2. So that means $4,500 of that $9,000 is subject to income tax. And then anything above $34,000, and remember her provisional income is $65,000. So she has $31,000 there, which is subject to income taxation. And we take $31,000 times that by 85%. That means $25,000 is subject to income taxation. Add these two numbers, and that gives us $29,575. But only 85% of the benefit max can be subject to income taxation. That's it. Only 85% can be subject. So we take the lesser of these two amounts, $29,000 and $2,500. So does that kind of make sense? Let's talk about that again. I want to run through that. She has $65,000 provisional income. How did she have that? By half her Social Security benefit and all of her IRA distributions. $65,000 provisional income. Now the provisional income determines how much of her Social Security benefit is taxed. So she has $30,000 of Social Security benefit. The first $25,000 of provisional income is free, all right, because it's not subject to any income tax. That leaves us $40,000 left to be taxed. Of that $40,000, $9,000 is taxed at 50%. It's not taxed at 50%. 50% of $9,000 is subject to income tax, which is $4,500. 85% of the remainder, in this case $31,000, is subject to income tax, which is $25,075. We add these two numbers together, and we get $29,575 as a total amount that's subject to income tax. But under law, no more than 85% of your Social Security can be subject to income tax. So only $25,500 of her benefit is subject to taxation. All right, so now we got to keep going down. We're not done yet. We got to determine her tax. So we take her total IRA distributions, which equal $50,000. We take her taxable Social Security, which is $25,500, which means her adjusted gross income is all of $75,500. She has a standard deduction of $13,300, which means her taxable income is $62,200, which is in the 22% tax bracket. And that means her total taxable tax is $9,623. Can you believe it? Believe it. She is stunned to learn that by taking $20,000 out more from her IRA, she raised her taxes by $6,146, which is an effective 32% tax rate. Yep, it's actually 35% when you factor it all, because she had to pay more taxes on the Social Security, and that's what happens. Now you're paying more taxes on Social Security, plus you're paying taxes on the IRA, and that's where you get affected. But I can hear you say, wait a second, she's in the 22% tax bracket. How's her effective distribution 32%? Well, we just talked about that. Because now Social Security is being taxed, plus the income from your IRA is being taxed. You're paying twice. You're paying tax twice on the same amount of money. That makes me mad. All right. So how the Roth saves a day? Well, now we're going to look at Jane. Right. So remember, Judy had $80,000 total income, $50,000 from the IRA distributions, $30,000 from Social Security. Now Jane's total income is also $80,000, but in this case, it's $50,000 from a Roth IRA distribution and $30,000 from Social Security. So let's look at Jane's Income sources, 50,000 Roth distributions, 30,000 Social Security. Let's keep on coming down. Her provisional income is what? Well, Roth are not included in provisional income rules. Provisional income is only half of her Social Security benefit, which is $15,000, which means her taxable Social Security is the lesser of $25,500, which is 85% of her benefit, or zero because she has no taxable Social Security. So her taxable Social Security is zero. And what's her taxable distributions? She has none because it's all Roth IRA. She has no taxable Social Security. She has no taxable distributions, which means she has no income tax. Jane pays nothing on the $80,000 of income, where Judy paid almost $10,000. So who would you rather be? Who would you rather be? You'd rather be Jane. Now, I can hear everybody saying, yeah, but Josh, they had to pay taxes on the money going into the Roth. And that's true. That is true. Absolutely. But you're only paying tax on the income that goes into the Roth. You're not paying tax on the follow-ups, which is higher Medicare premiums, tax on Social Security, and tax on, I mean, you're talking a triple header. In fact, when another chapter, I'll show you how it's a quadruple header, because then you can also pay taxes on your ordinary or qualified dividends and long-term capital gain. When you have Social Security and you're at this one little bit of a threshold, you're going to have double taxation, triple taxation if you include an increase in Medicare premiums, and quadruple taxation when you factor in now you're at the threshold for having your qualified dividends and the long-term capital gain taxes as well. And we're going to talk about that. Don't get me wrong, in a different chapter. It's painful, man. So you pay a little bit of tax up front to contribute to a Roth today in order to avoid a lot of taxes in the back end, as we witness here by Jane versus Judy. So keep that in mind. And don't forget to go get the book and, of course, subscribe at heritagewealthplanning.com. You can get it for free, and you can see all these tables and how they work out. Absolutely do that for sure. And then don't forget to subscribe to the YouTube channel here by clicking that little button down there, subscribe. Hit the bell to be notified for future content, and then comments and thumbs up are always welcome. I appreciate it, guys. We'll see you next time on the Heritage Wealth Planning YouTube channel. Thanks now.